The United States' inconsistent tariff policies are burdening each household with thousands of dollars in additional costs every year. How severely is this tariff volatility putting the future of the U.S. economy and American businesses at risk? The Trump administration frequently shifted its rationale for imposing tariffs, citing reasons ranging from national security and immigration control to supporting domestic manufacturing and addressing trade imbalances. This inconsistency left both businesses and investors uncertain about the long-term policy direction. Professor Justin Wolfers of the University of Michigan described the approach as a solution looking for a rationale. For example, lithium-ion battery cells, imported directly from China, were subject to tariffs as high as 145%. However, if those same cells were assembled into laptops in Vietnam and then exported to the United States, the final product was only subject to the basic tariff rate of 10%. Economists have warned that tariffs could increase costs for the average U.S. family by thousands of dollars, annually significantly raising household expenses. A Reuters Ipsos survey found that 73% of Americans expect prices to continue rising as a result of ongoing tariff tensions. Each time new announcements regarding tariff expansions or escalations emerged, major Wall Street indices, such as the S&P 500 and NASDAQ, reacted negatively. In Asia, uncertainty over U.S. trade policies kept market movements within a narrow range. The University of Michigan's Consumer Sentiment Index fell to 52.2 in April, down from 57 the previous month, marking the fourth consecutive monthly decline amid concerns about the economic impact of tariffs. At the same time, inflation expectations for the next 12 months rose to the highest level since the 1980s, reflecting persistent anxieties over the cost of living. Rather than coordinating with allies, the Trump administration imposed a basic 10% tariff on nearly all imported goods and raised tariffs on more than 57 trading partners, asserting that such measures would strengthen our negotiating position. According to Reuters, this approach disrupted the global order, prompting traditional allies such as Germany, France, South Korea, and Canada to reconsider their strategic alignments, and in some cases seek to ease tensions with China by unilaterally imposing tariffs instead of building multilateral coalitions. The United States created an unintended self-isolation effect without the support of allied nations. American demands in trade negotiations became more difficult to advance. Persuasively in China, American beef, once valued at approximately $125 million per month, faced retaliatory tariffs of up to 125%. As a result, many restaurants, such as Home Plate BBQ in Beijing, switched entirely to sourcing beef from Australia. This shift underscored the vulnerabilities created when the United States was displaced from critical supply chains. According to Morgan Stanley, under a baseline scenario in which current tariff levels are maintained through 2025, the probability of a U.S. recession could rise as high as 70%. A recent Reuters survey similarly indicated that the likelihood of a recession increased to 45% following successive rounds of tariff escalations. The bond market has reflected these deeper concerns. The risk premium on 10-year U.S. Treasury bonds has reached its highest level in a decade. Other long-term bonds have also seen notable increases in yields, following tariff-related announcements signaling heightened investor unease about the country's economic outlook. From immigration and trade deficits to redefining the idea of the Western alliance, Europe is once again at the heart of Donald Trump's global agenda. What lies ahead for citizens on both sides of the Atlantic? In a July 2018 interview with CBS News, former President Donald Trump referred to the European Union as a FOE in trade matters, stating, "I think we have a lot of foes. I think the European Union is a FOE, what they do to us in trade." Now, according to Anthony Gardner, former U.S. ambassador to the EU, Trump believes internal division is the most effective way to weaken the bloc. Gardner noted that the EU has been undermined by years of criticism, as is happening now under Trump. During a meeting with Italian Prime Minister Giorgia Meloni in Washington on April 17, 2025, Trump expressed optimism about a potential trade deal with the EU, asserting that there will be a trade agreement, 100%. European Commission President Ursula von der Leyen reiterated the EU's preference for dialogue, but affirmed the bloc is prepared to take countermeasures if necessary, including the imposition of digital service taxes on U.S. companies. Should U.S.-EU relations deteriorate further due to divisive strategies or controversial remarks, consumers on both sides of the Atlantic may feel the impact of higher import tariffs, leading to rising prices, especially for European imports like automobiles, wine, and pharmaceuticals. In 2024, the European Union recorded approximately 912,000 first-time asylum applications from non-EU nationals, a 13% decrease from 2023's total of 1.05 million. The largest share of applications was received by Germany, 25%, followed by Spain, 18%, Italy, 17%, and France, 14%. The majority of asylum seekers came from Syria, Venezuela, and Afghanistan. President Trump has argued that current immigration policies pose significant challenges to European nations. In a recent statement, he claimed that the people of Germany are tired of a program that lacks common sense, especially regarding energy and immigration. Immigration continues to shape labor markets, social welfare systems, and community life across Europe. Many EU citizens have felt increasing pressure on housing, healthcare, and education infrastructure, particularly in major cities. However, immigration has also helped address labor shortages in key sectors such as agriculture, healthcare, and construction. Debates sparked by leaders like Trump and Prime Minister Meloni have brought to the forefront the broader question: should migration be managed primarily as a risk to control or as a resource to harness? In 2024, the U.S. trade deficit in goods and services with the European Union reached $235.6 billion, an increase of $26.9 billion compared to 2023. With Italy specifically, the U.S. recorded a $44 billion trade deficit, exporting approximately $32 billion in goods and services, while importing about $76 billion. Trump has emphasized the need for fair trade relationships, calling on partners such as the EU and Italy to help reduce the imbalance. He has argued that bilateral trade must be adjusted to ensure reciprocity. In an attempt to ease tensions, the EU has proposed eliminating industrial tariffs on both sides, excluding agricultural products. However, the Trump administration has insisted on including agriculture in the negotiations, causing talks to stall. If either side imposes tariffs, consumers may face higher prices for European products like wine, cheese, and cars, as well as for American electronics. Small businesses, particularly exporters, could also be adversely affected. Anthony Gardner has underscored Italy's unique position in the EU, noting that it received the largest allocation from the bloc's post-pandemic recovery fund, approximately $191.5 billion under the Next Generation EU program. Gardner advised that Prime Minister Meloni should remain mindful that she represents not only Italy, but also the broader interests of the EU. According to Eurostat data, as of December 2024, around 51% of Italy's total exports were directed toward EU member states, highlighting the country's significant reliance on the single European market. Former President Trump has previously asserted that the EU was formed as an economic competitor to the United States. He has argued that the bloc has taken advantage of the U.S. through what he perceives as unfair trade practices. Could Meloni become the special intermediary between the EU and the White House if Trump is reelected? A private meeting in Washington hints at significant signals. On July 13, 2023, Italian Prime Minister Giorgia Meloni met privately with former U.S. President Donald Trump at his Washington residence, just hours after her official meeting with President Joe Biden. Trump stated, We have a 100% chance of reaching a trade deal with the EU if I return to office, signaling an interest in reviving negotiation channels that had previously stalled. Meloni, for her part, emphasized the shared objective of making the West great again, underscoring a common alignment in conservative political values. Trump described Meloni as a strong and respected woman, adding that Europe respects her, suggesting she may serve as a potential bridge between Washington and Brussels in the event of his return to the White House, should trade talks resume under an America First approach. European consumers could face higher prices on imported goods. Conversely, American industries might be affected by potential EU retaliatory measures if relations turn tense. Meloni, with a long-standing personal rapport with Trump, could help ensure a more stable dialogue, mitigating the risk of sudden policy shifts between two of the world's largest economies. During the Biden administration, a temporary agreement was reached, but by March 2025, Trump reinstated a 25% tariff on steel and aluminum, prompting the EU to prepare retaliatory measures worth 26 billion euros. In 2023, trade in goods and services between the EU and the US reached 1.6 trillion euros, accounting for roughly 20% of the EU's total global trade volume. Trump has previously referred to the EU as a trade adversary and opposed multilateral agreements like the TTIP, preferring bilateral negotiations. He has also criticized the EU's regulatory stance on US tech companies. The EU remains concerned that renewed tariffs could disrupt exports and supply chains. In response, Brussels is pushing forward its strategic autonomy agenda, aiming to reduce dependency on the US in sectors like defense and technology. Instruments like the Carbon Border Adjustment Mechanism, CBAM, and data protection regulations, GDPR, are being enforced to safeguard the EU's long-term interests. While Germany and France back the idea of an independent European defense strategy, Italy, under Meloni, has signaled a more pragmatic approach toward cooperation with Trump and the Republican Party. This divergence could complicate the EU's ability to present a unified stance in response to evolving US policies. As the 2024 G7 President and Prime Minister Giorgia Meloni chaired the G7 summit held in Fasano, Italy, from June 13th to 15. The summit marked a historic first, with the participation of Pope Francis, alongside leaders from member nations and international guests. Meloni has maintained a personal connection with former President Trump since before her premiership. She was the only EU leader to attend his inauguration in January 2025. However, other EU leaders, such as French President Emmanuel Macron and German Chancellor Olaf Scholz, have kept a degree of distance from Trump. They maintain that any bilateral arrangements must stay within the EU's collective framework to preserve unity and prevent internal divisions. If Meloni succeeds in her role as a mediator, EU citizens could avoid additional tariffs from the US, stabilizing import prices and protecting jobs in export-oriented industries. American consumers, in turn, could benefit from continued access to European goods, particularly automobiles, wines, and high-end products. The United States has recently imposed a 10% tariff on goods imported from the United Kingdom, presenting significant challenges to the British economy. However, could this development also present a potential opportunity for the UK to thrive in the face of global uncertainties? The 10% tariff on UK goods entering the United States officially came into effect on Wednesday. While this rate is considerably lower than tariffs imposed on other countries, it is still expected to have a noticeable impact on the UK economy in the short term. Industries such as automotive and pharmaceuticals are likely to face the most significant effects. The UK's automotive industry, home to prominent brands like Jaguar Land Rover and Mini, is forecast to be particularly affected. Manufacturers may encounter increased costs due to the tariffs, forcing them to adjust production or seek alternative markets to mitigate the damage. Specifically, factories in Oxford, where Jaguar Land Rover and Mini vehicles are produced, could face production scale downs, threatening approximately 25,000 jobs. Moreover, pharmaceutical companies like AstraZeneca and GlaxoSmithKline, major exporters to the U.S., will also face challenges in maintaining profitability. Around 40% and 50% of their products, respectively, are exported to the U.S., and higher tariffs could reduce the competitiveness of these products in the American market. According to a recent financial report from the Bank of England, the UK's financial markets remain stable. British banks have also demonstrated a strong capacity to support households and businesses, should the economy face further difficulties in the future. However, financial experts advise against withdrawing investments in the face of short-term volatility, as stock markets tend to recover after brief recessions. While the trade war initiated by Trump has created difficulties for many countries, it could present an opportunity for the United Kingdom to attract foreign investment. The UK has seen a decline in foreign investment in recent years, primarily due to uncertainties surrounding the political and economic situation post-Brexit. However, the 10% tariff imposed by the US on UK goods may make Britain a more appealing option, especially compared to other nations within the European Union, where US tariffs are over 20%. Investors are likely to seek countries with stable and low tariff environments to maintain their competitiveness. With relatively low tariffs from the US and the UK achieving a certain level of political stability following the recent governmental power transition, the UK could attract more foreign investment. Prime Minister Rishi Sunak and other UK political leaders have emphasized the importance of re-establishing trade and political relations with the European Union to alleviate the challenges brought about by Brexit. The UK is seeking to strengthen ties with the EU, especially in the areas of economic and defense cooperation. This is evident through plans for a UK-EU trade conference, scheduled for May 19th, aimed at improving trade conditions and removing barriers to the exchange of goods and services. If the UK can reach agreements with the EU on trade facilitation measures, such as mutual recognition of qualifications and defense collaboration, this will be a crucial step in strengthening the UK's economic position in the future. Donald Trump aims to revive the Plaza Accord, but this time leveraging tariffs and military withdrawals. Will this strategy undermine the US dollar's position and jeopardize America's financial credibility? In the aftermath of the 1985 Plaza Accord, a pact between the US, Japan, Germany, France, and the UK, the US dollar fell by 50% over 2 years. The agreement succeeded in making American goods cheaper, reducing the trade deficit and supporting domestic production. But it also led to a prolonged asset crisis, especially in Japan. Now, Trump wants to replicate this strategy with his so-called Mar-a-Lago Accord. But instead of cooperation, he's choosing confrontation by imposing tariffs and even threatening to withdraw military support. These moves could raise import costs, affect consumer prices, and diminish global confidence in the US dollar. Trump's administration has been pushing a strategy aimed at devaluing the US dollar by imposing strong tariffs and threatening to withdraw military support from uncooperative allies. Economic advisor Stephen Moran has suggested raising import tariffs to 50%, a significant jump from the current average of just 2%. The goal? To pressure other countries to adjust their exchange rates in favor of the US. This approach has sparked negative reactions. In the financial markets, the US dollar dropped by more than 1% against a basket of major currencies, hitting its lowest point in 3 years. Meanwhile, US Treasury yields increased due to concerns over the government's ability to meet its debt obligations. The devaluation of the dollar has made imports more expensive, contributing to inflation. In March 2025, import prices fell slightly by 0.1%, but warnings suggest they could rise again due to the new tariff policies. Treasury bond yields have surged to their highest levels since 1982, all due to growing concern about Trump's economic confrontational strategy. American citizens are now facing a double impact: higher living costs and more expensive consumer loans. A recent survey revealed 63% of global fund managers believe the U.S. dollar could lose its status as the world's reserve currency within the next 5 to 15 years. The Trump administration is considering withdrawing its security umbrella, meaning halting military support from NATO allies who failed to meet defense spending targets. On February 10, 2024, at a rally in South Carolina, Trump declared that if NATO countries don't pay their fair share, he would encourage Russia to do whatever they want with those nations. This move marks a major shift in U.S. foreign policy, raising questions about America's commitment to global security. NATO Secretary General Jens Stoltenberg warned that such statements could undermine the security of the entire alliance and put both us and European soldiers in danger. Additionally, defense spending would likely increase, putting pressure on national budgets and social programs. The Trump administration is proposing a controversial financial policy, urging nations holding U.S. debt to switch to 100-year bonds with low or zero interest rates. The goal: reduce government borrowing costs amid rising interest rates and a national debt surpassing $36.2 trillion, with around $9.2 trillion set to mature in 2025. However, this proposal is raising concerns about the U.S.'s credit reputation. Europe's Scope Rating Agency has warned that if current trade and financial policies continue, the U.S. could face a downgrade in its credit rating. Howard Marks, co-founder of Oaktree Capital, has cautioned that overuse of America's golden credit card, the ease of borrowing driven by investor trust, could have severe consequences if that trust is eroded. For American citizens, borrowing costs may rise, impacting home loans, tuition fees, and personal consumption. For the government, losing investor confidence could make it more difficult to fund social and defense programs.